What they don't want you to know. Have you ever looked at the stock market, then looked at the economy, and wondered how the two could possibly exist in the same universe? Because right now, the disconnect isn't just strange, it's historic, unprecedented, almost unnatural. Inflation is still eating away your savings. Debt is exploding. Layoffs are rising. Banks are wobbling. Commercial real estate is collapsing. Consumers are drowning in credit. The world is de-dollarizing. Global tensions are surging. Growth is slowing. And the middle class, barely hanging on. By every traditional measure, the stock market should have crashed already. Not corrected, not pulled back, not cooled off, crashed. But it hasn't. In fact, it's near record highs. And the question everyone keeps whispering, but nobody wants to say out loud, is this: why hasn't the stock market crashed yet? What force is keeping this whole thing afloat? And how much longer can it last? Because if you think this is normal, it's not. If you think this is sustainable, it's not. If you think this is just a strong economy, it's definitely not. You're about to discover the truth. The truth they don't want you to know. The truth that financial elites quietly understand, but would never dare say publicly. Because once the majority realizes what's actually happening, the entire illusion collapses. Let's pull back the curtain. The first secret. Markets are no longer priced by reality. There used to be a time when stock prices reflected something real. Earnings, demand, fundamentals, economic growth, productivity, innovation. Those days are gone. Now, the market moves on liquidity, not logic. On flows, not fundamentals. On expectations, not earnings. On central bank behavior, not company performance. The market isn't a reflection of the economy anymore. It's a reflection of monetary conditions. When money is cheap, markets rise. When money is abundant, markets explode. When liquidity flows, valuations detach from reality. The real economy can be burning to the ground, and stocks can still go up. Because today's market runs on one fuel: liquidity, not truth. And liquidity is still sloshing through the system in amounts the public can't see. Not because things are good, but because the people in power know what happens if it dries up. The second secret. The Fed can't let it crash. Everyone thinks the Federal Reserve controls the market. That's wrong. The market now controls the Federal Reserve. Because if the market crashes, pensions collapse. Tax revenue collapses, credit markets freeze, unemployment spikes, banks fail, corporate debt implodes, consumers' spending collapses, the entire economy breaks instantly. The Fed knows this. Washington knows this. Wall Street knows this. So they've created a system where markets can never be allowed to crash again. At least not the way they used to. Every time something breaks, the Fed steps in. 2008. Bailout 2020. Money printing 2023. Emergency bank backstops 2024. Stealth liquidity injections. They claim they're fighting inflation. They claim they're tightening conditions. They claim they're reducing their balance sheet. But quietly, behind the curtain, they're keeping the financial system alive with hidden liquidity injections. Because the alternative isn't a recession, it's collapse. The stock market hasn't crashed because it's not allowed to crash. Not yet. The third secret. Corporations are propping up their own stocks. This is the part most people never learn. Over the last 15 years, corporations haven't gotten richer by selling more products. They've gotten richer by manipulating their own stock prices. How? Through stock buybacks, the single most powerful force driving the market higher. Instead of investing in innovation, companies borrow money, then use that money to buy their own shares. This does three things. 1. Reduces shares outstanding. 2. increases earnings per share, artificially 3, pushes the stock price higher. It's financial engineering, not economic strength. Companies today don't rise because of growth. They rise because they're buying their own stock at historic levels. And they're not doing it because they believe in their businesses. They're doing it because they're terrified of the alternative, a real market valuation, a world where stocks trade based on reality, not manipulation. Corporations know the truth. If they stop supporting their stock prices, the market collapses. So they keep buying. The fourth secret: the US can't afford a crash. Here's the part that should scare you. America is drowning in so much debt. A true stock market crash would be fatal. Not painful, fatal. Because a crash increases borrowing costs, debt interest, credit stress, refinancing risk. And when you have $36 trillion in debt, with over $1 trillion per year in interest payments, you can't survive higher borrowing costs. A crash would force the government to spend trillions more in stimulus, money it doesn't have. It would force the Fed to re-enter money printing at levels that would obliterate the dollar. It would destroy confidence at a time when the world is already slowly abandoning US dominance. If the stock market falls, the US deficit rises. The interest burden rises. The dollar falls. Foreign investors flee. The system breaks, so the people in charge prop the market up. Not because the economy is strong, but because they're terrified of what happens if it falls. The fifth secret: the real market already crashed. You just weren't told. Here's something almost nobody realizes. Adjusted for inflation, adjusted for purchasing power, adjusted for dollar devaluation. The real stock market has already fallen. Not in nominal terms, but in real terms. Because when your dollar buys less each year, a record high doesn't mean you're richer. It means your money is weaker. A $100 stock that goes to $120 isn't a gain if your dollar fell 25% in value. This is the illusion they built. Inflation makes asset prices appear strong, while making you poorer at the same time. It's the perfect trick. A crash has already happened. They just hid it under inflation. So why hasn't the stock market crashed yet? Because everything is being held together with emergency liquidity, corporate buybacks, financial engineering, manipulated rates, hidden interventions, coordinated monetary policy. But pressure like this does not disappear. It builds and builds and builds until one day something snaps. And when it does, the market won't dip, it won't correct, it won't normalize, it will break. Because the forces holding it up are artificial, temporary, unsustainable. And the forces trying to pull it down, debt, inflation, interest burdens, declining productivity, de-dollarization, demographic collapse, those forces are real. The only question now is, what triggers the moment everything finally cracks? Now that you understand why the stock market hasn't crashed yet, let's talk about the part nobody dares to say publicly. Just because it hasn't crashed doesn't mean it isn't going to. In fact, the opposite is true. The longer a system fights gravity, the harder it falls when gravity wins. And what's happening right now is a historic balancing act. A desperate attempt to keep an overinflated market standing on a foundation cracking in slow motion. The pressure is building. The weight is increasing. The illusion is thinning. And the smallest spark can ignite the biggest collapse of our lifetime. Let's look at the triggers. Trigger number 1. The debt bomb. This is the monster hiding in plain sight. America's national debt has exploded to $36 trillion, growing by roughly $1 trillion every 100 days. Every time the government issues new debt, someone must buy it. But foreign buyers? They're stepping away. US banks? Already drowning in unrealized losses. So, who buys the debt now? The Federal Reserve, which means money printing by another name. This creates a deadly loop. More debt, more printing, more inflation, more rate pressure, more debt. At some point, the interest on that debt becomes unpayable. We're nearly there. When interest payments exceed federal tax revenue, the financial system snaps. And when that happens, investors flee the stock market. Not slowly, but instantly. This is the trigger Washington fears most. Trigger number 2, corporate refinancing hell. Corporations thrived when money was free, 0% interest, endless borrowing, cheap leverage. But those days are over. Now, companies must refinance their old loans at double or triple the interest rate. Think about that. A company paying $200 million per year in interest might soon pay $600 million. Margins collapse. Profits evaporate. Layoffs begin. Debt defaults rise. And the stock market, which is priced for perfection, cannot survive the reality of rising defaults. Wall Street analysts won't tell you this, but corporate America is staring into a refinancing abyss. And the market is not priced for that. Not even close. Trigger number 3. The banking crisis isn't over. They told you the banking crisis was contained. It wasn't. Banks still hold massive portfolios of long-term bonds that are worth far less today because interest rates skyrocketed. Those losses are hidden, buried in accounting categories like held to maturity. But math doesn't care about accounting tricks. Banks are insolvent the moment depositors panic. Why does this matter? Because a bank failure doesn't just threaten the banking system. It forces the Fed to intervene again, which means more liquidity injections. More liquidity, more inflation. More inflation, higher rates. Higher rates, more bank stress. You see the trap? It's a loop with no escape. One major bank failure could trigger the very crash the Fed has been trying to prevent since 2008. Trigger number 4. The consumer collapse. The average American is out of money. Savings rate? Near historic lows. Credit card debt? Record highs. Auto loan delinquencies? Surging. Rent? Unaffordable. Mortgage rates? Crippling. For 15 years, the economy was kept alive using cheap credit. Now that credit costs more. The consumer, the backbone of the U.S. economy, is breaking. And here's the horrifying truth. When the consumer breaks, the corporation breaks. When the corporation breaks, the stock market breaks. We are watching this domino chain fall in real time. The data is there. The warnings are there. The stress signals are everywhere. But the market? Still floating. For now. Trigger number 5. The lie of the soft landing. The Federal Reserve keeps telling you, we're engineering a soft landing. That phrase is a psychological trick designed to keep public confidence intact. But here's the truth. Soft landings don't happen at the end of debt supercycles. They don't happen when inflation is structural. They don't happen when rates are elevated for years. They don't happen when the global economy is fragmenting. They don't happen when the U.S. is losing reserve currency dominance. America isn't landing softly. It's stalling at 30,000 feet. And when a plane loses power at altitude, the first few seconds feel calm. Right before the drop. Trigger number 6. The global breakup with the dollar. You've seen the headlines. BRICS expanding. Saudi Arabia trading oil in other currencies. China and Russia building alternative payment systems. Central banks buying record amounts of gold. Countries reducing U.S. Treasury exposure. This isn't random. It's coordinated. De-dollarization weakens the dollar. A weaker dollar increases inflation. Higher inflation forces higher interest rates. Higher interest rates crush stock market valuations. This is mechanical, predictable, unavoidable. Most Americans have no idea how closely the stock market is tied to dollar dominance. But the elites know. They know once the dollar weakens enough, U.S. stocks can't stay inflated. The bubble pops. Trigger number 7. The final unraveling. Confidence. Every market in history is held together by one fragile thing. Belief. When investors believe prices will rise, they buy. When investors believe the system is strong, they stay invested. But belief is emotional. It flips quickly. And once confidence breaks, it doesn't return. All it takes is one major shock. A bank failure, a credit event, a geopolitical conflict, a treasury auction collapse, a surprise inflation spike, a corporate debt meltdown. One spark, one moment, one headline, and belief evaporates. That is when the stock market finally crashes. Not gradually, but violently. Because markets don't collapse when things get bad. They collapse when people realize things were bad all along, and that moment is coming, sooner than the experts admit. If this opened your eyes, subscribe, because the next few years will rewrite financial history, and most people will be blindsided. Comment what trigger you think breaks first, and share this with someone still asleep. Preparation isn't paranoia. It's survival.